Welcome to Woods of Stardom. This is CH. I will be covering the LionGlobal All Seasons Fund Growth and LionGlobal All Seasons Fund Standard in this video, which is part of my Absolutely Biased Comments or ABCs series. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. While these are two funds, the investment process behind them are the same, hence I've decided to cover them together. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. This video is done as a follow-up request from a viewer's comment in my previous video covering the Fidelity Global Multi-Asset Income Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos, and I'll be happy to work on it as long as I can find enough information on the product. LionGlobal Investors is a Singapore-based asset management business that was rebranded in 2008 from Lion Capital Management and is a result of the merger of the asset management businesses from OCBC and Great Eastern in 2005. OCBC is the second largest banking group in Singapore, while Great Eastern is the largest and oldest life insurance company in Singapore and Malaysia. Great Eastern and LionGlobal Investors are both subsidiaries of OCBC. LionGlobal Investors currently has about 79 billion Sing dollars of AUM, with core competencies in long-only mutual funds and ETFs across fixed income, equities, and multi-asset solutions. Given the nature of the setup, there is a notable tilt in the product offerings towards servicing OCBC retail banking business and the private banking business under the Bank of Singapore or BOS entity. LionGlobal Investors also has several collaborations with other local and overseas financial firms to launch market or thematic focused products. The LionGlobal All Seasons Fund Growth and Standard are two sub-funds under the LionGlobal New Wealth Series fund family. This fund family is set up as a Singapore open-ended umbrella unit trust. The two funds are registered as MAS authorized schemes, which means they are suitable for retail investors. The LionGlobal All Seasons Fund Growth and Standard lists Herbert Wong as the fund manager in the fund web pages. Morningstar also lists him as the only manager since the inception of the fund. The fund prospectus actually lists 3 more co-managers for the two funds and provide their bios as well, which is good. All 4 of them are under the multi-asset strategies team in the firm, where Herbert is the head of the team and also the lead portfolio manager for the funds. It is mentioned that Kim Ping is responsible for the selection and monitoring of external fund managers, which is important for these two funds. There is, however, no mention of specific responsibilities of Andrea and Desmond. There is also no information whether they join in co-managing the funds since the fund inception or only sometime thereafter. The LionGlobal All Seasons Fund Growth and Standard actually have almost exactly the same investment objective with just one different word stated in their web pages and fact sheets. This goes to show that investment objectives are typically quite general, and it is not enough to rely on just that to understand a fund. There are some key information we can gather from the investment objective though. It is stated that the aim of the funds are to generate capital appreciation, so we know that income generation or providing distribution yield is not a priority. It is also stated that the funds invest in a multi-asset portfolio of active funds and ETFs, so we can gather that the funds are mainly focusing on providing an asset allocation strategy and as well providing their fund and ETF selection capabilities. This also means there are probably no direct stocks and bonds in the portfolio, nor is there a need to have a stock or bond expert in the manager team. LionGlobal fortunately has a featured fund page that provides a much better summary of what these two funds are all about. They are essentially global diversified balanced funds investing into both passive and active strategies through picking suitable ETFs and mutual funds, and are designed for Sing dollar-based investors. Low cost appears to be one of the key selling features of the funds, and we will talk about this later in the share classes section. There is also a mention of 8 investment approaches, but I never managed to figure out what this means while making this video. The key difference between the two funds lies with the asset allocation strategy. The Growth Fund has a 70% equities, 30% bonds allocation, while the Standard Fund has the reverse, which is 30% equities and 70% bonds. There is still quite a lot of flexibility available beneath these two asset allocation frameworks for the investment team to strategize and determine on the sub-asset class exposures. Let's go through the prospectus to find out more. The prospectus unfortunately doesn't offer much more details. There is, however, a paragraph that lists some funds and ETFs where the All Seasons funds can invest more than 30% each, which means these are underlying products that are identified as key building blocks for the two funds. This is followed by a long section with the investment objectives of each of these funds and ETFs that I don't find much purpose including in this video. Investors who are interested can take a look at the prospectus. One observation to note is that among these key building blocks, it seems that all active mutual funds identified are LionGlobal products, and there are pros and cons for doing this. The pros are that LionGlobal has full control in the management fees of these LionGlobal funds and can therefore reduce or waive them off in order to offer a low-cost structure. The cons are that LionGlobal is an Asia-focused fund provider and therefore has better competency in Asia products only. So it may be that there won't be active funds used for non-Asia exposures in the portfolio. This also assumes LionGlobal funds are better performers than its competitors, which will not necessarily be the case. LionGlobal does benefit with AUM getting added to the underlying funds. The base currency of the two funds are stated as Sing dollars. There is, however, no mention of currency hedging strategies, so I wonder how the funds handle non-Sing dollar exposures from underlying funds and ETFs that are not traded in Sing dollars. Last but not least, it is stated in the prospectus that the two funds do not have a benchmark defined. I find it important for funds to have a benchmark or at least a target return objective, so that investors can at least compare the fund performance against something defined to determine if the fund is doing good or bad. Given the two funds have a predetermined high-level asset allocation of 70% equities plus 30% bonds and vice versa, I don't understand why LionGlobal can't just use, for example, a 70% MSCI World Index plus 30% Bloomberg Global Aggregate Index as the benchmark. LionGlobal unfortunately did not provide any information on the two most important areas in the investment strategy for these funds, that are the asset allocation approach and the fund or ETF selection approach. These are crucial for investors to understand how the fund really works, and it is strange that no information is provided. The LionGlobal All Seasons Fund Growth and Standard were both incepted on the same day in 2018, which gives about 7 years of track record now. The AUM of the funds, however, look quite small, at 204 million Sing dollars for Growth Fund and 144 million Sing dollars for Standard Fund. I'm not sure if this is because LionGlobal didn't actively promote them in the past, or if these funds were repurposed recently from other obsolete funds. But the small AUM is a concern in terms of the survivability of the funds. I think they need to quickly reach a 300 to 500 million Sing dollars AUM size to reach a stable stage. Given the funds already have predefined high-level asset allocation models as seen in the featured fund page earlier, let's go through the portfolios of the two funds side by side. Portfolio details are only available in the fund fact sheets, with the latest available being end September version. The actual high-level asset allocation looks pretty similar to the models. There is no mention how much deviations are allowed, though if I make a guess, I would think a maximum 5% deviation would make sense. The fund fact sheets provide a second layer of asset allocation by geographic or country breakdown, and separates them by equities versus bonds exposures. Equity exposures for both funds look nearly the same, with roughly one-third in US, one-third in Europe, and one-third in Asia including Japan. This is clearly very different from the typical MSCI World Index that has about two-thirds US and very little in Asia. Bond exposures also look very different from typical global bond indices. Again, both funds look nearly the same with over 50% in Singapore specifically, and about 25% in Asia ex-Japan. The fund fact sheet also provides actually the full holdings list of all the underlying mutual funds and ETFs, where we can get some additional insight on how the funds are being managed. As mentioned earlier, the two funds will invest in other LionGlobal products where possible, and in this case applies to the Asia equity and bond exposures. This means that if you believe that LionGlobal's Asia equity and bond funds are good products, these two funds will help give you a portfolio that contains these good products and in turn generate good returns. The reverse is true, being that if you already do not like LionGlobal's funds or think that they are not good performers, then these two funds will end up giving you a subpar experience because they cannot generate the performance you are looking for through these underlying positions. Also, as mentioned earlier, other considerations to invest in other LionGlobal products include fee reduction and also helping to boost the AUM of these products through these two funds. We can also see that while there are some small differences in the allocation weights of the underlying products, they are not significant. Using the bond exposures as example, the relative weights look quite similar. There doesn't seem to have any different investment considerations between the two funds. Say for example, the growth fund might have more high-yield bond exposures to get better growth potential, while the standard fund might have more short-term government bonds for capital preservation. The same is observed with equity exposures. Besides the Asia exposures covered by LionGlobal funds, the other exposures are mainly the typical ETFs tracking the broad indices such as S&P 500 and Euro stocks. There appears to be more equity ETFs in the growth fund, but most of them have less than 1% allocation, and therefore it's not practical to allocate in the standard fund. So from this data, we can gather that while the funds do run a global multi-asset strategy, they are very different from the usual global strategies. Instead, these funds have a pretty high bias in Asia and Singapore specifically, especially seen in the bond allocations. Another important point to note is that there doesn't seem to be any meaningful differences in the investment considerations between the two funds besides the high-level asset allocation model. The growth fund doesn't have any specific growth bias exposures, and the standard fund doesn't have any specific defensive bias exposures. You pretty much get the same underlying positions on relative weight basis. If I were to guess the investment process behind the scenes, I think it might look like this. I suspect the top-down allocation decisions are done in conjunction with the bottom-up product selection, whereby the team discusses how to allocate to LionGlobal products meaningfully in the portfolios while maintaining decent risk diversification and competitive returns generation. A model portfolio is then generated and it gets adjusted by weights accordingly into the growth fund and the standard fund. The LionGlobal All Seasons Fund Growth and Standard were incepted on the same day in 2018 and initially offers only accumulation Sing Dollar share class. Distribution share classes were created in subsequent years, probably in accordance to business demands. There are two types of distribution policy, and I will go through them in a while. There is also an accumulation US dollar unhedged share class created in 2024 for the growth fund. The share classes have a pretty low management fee of 0.25%. Adding other expenses gives a total expense ratio or TER of slightly different percentages. The accumulation Sing Dollar classes have a TER of around 0.4%. The other share classes have a slightly higher TER but are capped at 0.5%. The reason for the higher TER is likely due to smaller AUM of the share classes that resulted in other fixed expenses translating to higher percentage costs. This is one of the reasons why investors should try to avoid funds with too small AUMs. Up to 60% of the management fee can be paid by LionGlobal to distributors as trailer fees, although the fees are already low to begin with, so there really isn't much to be earned by LionGlobal and the distributors. Distributors can, however, charge up to 2% subscription fees for the funds, which is the other way for them to make revenue. As low cost is one of the fund's key selling points mentioned in the featured fund page, I want to spend a few minutes to elaborate on this. One key investor concern with fund of funds solutions is the double layer of fees. First layer for the main fund and another layer for the underlying funds. LionGlobal tries to minimize the underlying layer by rebating all the management fees of other LionGlobal funds in the portfolio as cash. This can't be done with funds from other providers. Therefore, the team has opted to avoid active mutual funds from other providers altogether. The remaining portfolio are the ETFs that typically have low fees anyways. Therefore, that 0.25% management fee seems to be really the only source of revenue for LionGlobal for these two funds, and might be even lower if LionGlobal has to share some of it as trailer fees to distributors. This is way lower than all other active global multi-asset funds in the market, and I do like it that LionGlobal has taken the direction towards lower fees. As mentioned earlier, the LionGlobal All Seasons Fund Growth and Standard has two types of distribution policies. One is called DIST for distribution, while the other is called DEC for decumulation. The fund prospectus actually provides detailed elaboration on the expected distribution payout yields and also states the differences in the policies. It is stated all the distribution share classes have a monthly payout frequency. Here is where it gets interesting. It is stated that the expected payout yield is about 3% for the distribution class and 5 to 8% for the decumulation class for both funds. Considering the asset allocation of the two funds are rather different, it is strange why the payout yields are defined at the same rate. This also implies that the payout yields are completely unrelated to the underlying portfolio yields, and is simply a conversion of the portion of the total returns into income payout. It is also clearly stated here what the decumulation class is all about. That is simply a share class that gives a more substantial payout yield than the distribution class. There is a possible risk that this can lead to a decline in the NAV over time, and LionGlobal will have to terminate the share class if the AUM falls below a predefined minimum size. I personally think it makes no sense to go for decumulation classes, since we want our investments to grow over time, not shrink. Additional distribution information of the funds is provided in a separate link in the LionGlobal website that downloads an Excel file containing the full distribution history of all the funds. From the Excel file, we can see that the share classes try to adopt a smoothened payout with generally stable dollar amounts over time. We can also see that the decumulation class consistently converts capital to top up to the payout amounts because there is simply not enough income generated from the portfolio for the payout yield. Using the Excel data, we can estimate the current payout yield of the share classes, and that calculates to around 2.8% for the distribution classes and 5.7% for the decumulation classes. To be fair, 5.7% doesn't look so bad, as I would expect both funds to be able to generate this amount of return across market cycles. I will be more worried if the decumulation classes are paying out around 8% levels. As the standard fund has a longer track record for its decumulation class, let's take a look at the NAV versus total return comparison in Morningstar. We can see that the NAV has a rather minimal growth over the years, so almost all the gains in the fund have been paid out as distributions. The consolation is that there hasn't really been a significant decline in the NAV so far, as the payout yield is not set at the higher end of 8%. The fact sheets of the LionGlobal All Seasons Fund Growth and Standard provide a cumulative performance chart and a performance table for various time periods. As there is no benchmark defined, it is rather difficult for us to figure out whether the funds are performing good or bad. So let's run some Morningstar comparisons. Firstly, let's compare the growth and standard funds. This is a since inception chart from 2018. And referring back to the performance table earlier, we know that growth has delivered about 7.13% per annum, while standard about 4.67% per annum. I would have thought growth can generate higher returns, given it has 70% equity allocation. So let's add some comparisons. If I were to construct a simple global multi-asset model, I may use, for example, iShares MSCI AC World ETF for equities and PIMCO GIS Income for bonds as a start. A 70-30 mix or 30-70 mix of these two products for the same time period would have given returns that are slightly higher than the LionGlobal All Seasons Fund Growth and Standard, but on the assumption that there is no rebalancing done. If rebalancing is done periodically, as with what normal multi-asset funds would do, the returns should be more similar to the LionGlobal funds. What if I try to construct a simple Singapore-focused multi-asset model? Here, I try to use, for example, the Amova Singapore STI ETF for equities and Eastspring Singapore Select Bond Fund for bonds. The STI unfortunately did pretty bad in 2020, and that dragged down the long-term performance, so it doesn't look so appealing to have a high bias to Singapore equity exposure. The Eastspring Fund, however, had a decent performance, and is even better than PIMCO GIS Income in the previous chart. Shifting to a shorter 5-year chart, we can see some benefits in having some Singapore equities in the portfolio. The past few years have generally been a bullish equity market, so this is not representative of long-term equity returns. I think the LionGlobal funds seem to have a slightly weaker performance, mainly because of the US equity underweight in the portfolio. While it may be a risk diversification decision, investors do need to take note of this if they are hoping to participate more in the bullish equity trends. Here is a chart comparing some of the established global multi-asset funds in the market from JP Morgan and BlackRock with their Sing Dollar share classes. JP Morgan Global Income and BlackRock GMI are bond heavy, while BlackRock Global Allocation is a 60% equity, 40% bond mix. We can see both the LionGlobal funds have actually done pretty well in performance versus these other funds. Here is a shorter 1-year chart comparing some of the other funds in the market with shorter track records, from Standard Chartered, UOB, and PIMCO. LionGlobal again has outperformed the equivalent peers in both the equity-heavy and bond-heavy groups. So from performance perspective, I have to say, the two LionGlobal funds have done pretty well. With that, let's summarize our findings. LionGlobal Investors is an asset management business under OCBC. While the overall AUM doesn't look too big, it does get ample support from the wider OCBC businesses. The two funds are managed by Herbert, the head of multi-asset strategies team, and 3 other team members. There seems to be some roles and responsibilities defined, although not clearly specified in all the bios. These are global multi-asset strategies in a fund of funds and ETFs implementation approach. However, the exposures are not what you find in typical global multi-asset solutions. The high-level asset allocation of 70% equities, 30% bonds for growth fund, and 30% equities, 70% bonds for standard fund seems to be fixed, but the sub-asset allocations look highly flexible. There is a clear mandate to include LionGlobal products into the portfolios where feasible. So the resulting portfolios have a high bias in Asia equities as well as Asia and Singapore bonds, through various LionGlobal funds. Other exposures are implemented using passive ETFs, typically covering the broad markets, though there seems to be a deliberate allocation decision to significantly underweight US equities at the moment. There is nothing wrong with these allocation decisions, although there is no elaboration on the investment process, so we don't really know how these decisions were derived. The growth and standard funds appear to be different only in the high-level asset allocation definition. Underlying exposures are near identical and are simply adjusted in weights proportionally. So investors will not, for example, find more high-yield bond exposures in growth fund and more short-term government bond exposures in standard fund. With only about 200 million Sing dollars of AUM in each fund, this is a pretty small size for a 7-year-old solution. The funds need to quickly grow to at least 300 to 500 million Sing dollar levels to be more stable and sustainable. Distribution share classes in both funds are defined to have the same payout yields, and this regards the underlying portfolio yield. While the funds are designed with only capital appreciation in mind, the two funds have different return expectations, and therefore it is odd to have the same payout yields. The decumulation share classes that have a higher payout yield will likely sacrifice NAV, and therefore is not good for long-term investing. The funds have no defined benchmark or target returns, making it difficult to assess whether the funds are doing good or bad. That being said, the returns of the two funds look to be decent from a broad asset allocation perspective. They are also strong performers in Sing dollar terms compared to other global multi-asset funds in the market. Last but not least, with TER at 0.4% to 0.5% and fee rebate of underlying funds, this is probably the cheapest multi-asset fund I have seen in the market so far. The low fees is definitely a contributor to the performance of the funds, considering most other similar funds in the market have around 1.5% to 2% TER. In conclusion, both the LionGlobal All Seasons Fund Growth and Standard have exhibited strong performance track record for Sing dollar investors. They are, however, not the typical global multi-asset solutions, with their strong biases in Asia equities and bonds, as well as significant underweight in US equities. The two funds are also still quite small in AUM currently, and they obviously have various other LionGlobal funds in the underlying portfolios. If you are okay with these points, the growth or standard funds may be a worthy consideration. This concludes my absolutely biased comments on the LionGlobal All Seasons Fund Growth and LionGlobal All Seasons Fund Standard, and I hope it will help in your investment journey. May we all grow wiser and prosper.